Namaskar, welcome to Satya Skills. In this video, let us try to understand the meaning of scheduled banks, CRR and SLR of RBI. Scheduled banks are those banks which are listed in the second schedule of the Reserve Bank of India Act 1934. Any bank in India can become a scheduled bank. To become a scheduled bank, the bank has to satisfy a few conditions such as its minimum paid up capital must be 5 lakhs. A scheduled bank enjoys several privileges from the RBI. They can get loans in times of need and emergency. RBI offers several services such as rediscounting of bills at lesser rate and granting loans at concessional rate, usually at bank rate. RBI also provides training facilities to the employees. It gives necessary guidance to the scheduled banks. A scheduled bank has to maintain some balance as cash reserve, that is like a deposit with the RBI. The scheduled banks can automatically become members of the clearing house. At present, all commercial banks of both public and private sector, all foreign banks in India, RRBs, state cooperative banks, small finance banks, payment banks, etc., all are in the list of second schedule of the Reserve Bank of India Act 1934. Other banks which are not in the list of second schedule are called non-scheduled banks. All scheduled banks are to provide required cash deposits with the RBI, this is mandatory. They also need to submit periodical reports on their activities to the RBI. They work under direct guidance and regulation of RBI. In return, RBI provides a kind of protection to scheduled banks. Then second topic for today's discussion is cash reserves. In India, it is legal obligation to all the banks to maintain some cash reserves with the RBI in accordance with the provisions of RBI Act and Banking Regulation Act. First one is CRR or Cash Reserve Ratio. Cash Reserve Ratio refers to the cash reserves to be maintained by banks with the RBI. According to RBI Act, all banks are expected to maintain 3% to 15% of total demand and time liabilities in the form of deposits with the RBI called Cash Reserve Ratio or CRR. The percentage will be announced by the bank from time to time. According to the needs, the RBI varies CRR. The CRR is applicable to all the scheduled and non-scheduled banks equally. When the RBI suspects inflationary trends, it increases CRR as a technique to check flow of cash into the circulation. To that extent, all the banks has to deposit cash with RBI and it directly reduces the bank loans to the public. If the RBI finds depression or shortage of funds, RBI reduces the CRR and more funds will be at the disposal of the banks and banks can lend more to the public. Provisions regarding CRR are given in RBI Act 1934. The bank used CRR as a credit control weapon for the first time in 1972. RBI used it as a credit control technique several times and since then it was gradually increased and reached 11% in 1988. But today, as on today, it is 4% only. Thus, variation of cash reserve ratio is a powerful technique as it directly influences the lending capacity of the banks. Second one is statutory liquidity ratio, popular as SLR. The Banking Regulation Act 1949 consists of provisions on SLR and it is a secondary reserve requirement to be maintained by banks with the RBI. When it was introduced, it was 20%, later increased up to 38%. Now, it is only 18%. SLR is a percentage of cash in hand with the RBI or any other public sector bank or holdings of approved government securities. Unlike CRR, for SLR, banks need not maintain cash reserves with the RBI. If the RBI holds approved government securities up to the limits prescribed by the RBI, that comes under SLR. It means to that extent required by the RBI, banks can hold approved government securities. Remember, again this is also a percentage on the demand and time liabilities of the banks. Statutory liquidity ratio was introduced to check undue expansion of bank credit, to encourage banks to invest in government securities and to ensure liquidity of banks. That is the most important one. RBI uses two ratios, CRR and SLR, as weapons to control extra credit that flows into the public through bank loans. That's all in this video. Thank you for watching. God bless you.